Macklem. They're going to announce the interest rate and the monetary policy report. They will make statements. Then we will go to questions. Before we start, I can see all your hands. Before we start, please turn off your cell phones, and you can raise your hands now. Go ahead.
Okay. Well, good morning. Bonjour tout le monde. Tiff and I are very pleased to be here with you today to discuss our monetary policy report from July, which the bank just published this morning. A few points. Global economic growth remains quite modest, although the pace of economic activity varies significantly across the major economies. The U.S. economic expansion is proceeding at a moderate pace, but the continued strengthening in private demand is being partly offset by the impact of fiscal consolidation. Au Japon, la détente budgétaire et monétaire contribue à un redressement rapide de la croissance économique. Dans la zone euro, par contre, l'activité reste faible. En Chine et dans les autres économies émergentes, la croissance du PIB réel ralentit, même si elle est plus vigoureuse que dans les économies avancées. Cela exerce une pression à la baisse sur les cours mondiaux des produits de base. Et, par conséquent, la Banque a revu légèrement à la baisse ses prévisions de croissance pour l'économie mondiale. La Banque s'attend encore à ce que l'économie du globe raffermisse en 2014 et en 2015. In Canada, economic growth is expected to be choppy in the near term, owing to unusual temporary factors. The overall outlook is little changed from the bank's projection in April. Annual GDP growth is projected to average 1.8% in 2013 and 2.7% in both 2014 and 15, supported by very accommodative financial conditions. Despite ongoing competitiveness challenges, exports are projected to gather momentum. This should boost confidence and lead to increasingly solid growth in business investment. The economy will also be supported by continued growth in consumer spending, while further modest declines in residential investment are expected. Growth in real GDP is projected to be sufficient to absorb the current material excess capacity in the economy, closing the output gap around mid-2015. L'inflation a été basse ces derniers mois et devrait le demeurer à court terme. La faiblesse de l'inflation mesurée par l'indice de référence reflète, premièrement, une marge notable et persistante de capacité excédentaire. Deuxièmement, des pressions concurrentielles accrues chez les détaillants. Troisième, une progression des salaires relativement modérée. Et quatrième, certains facteurs sectoriels temporaires. L'inflation mesurée par l'IPC global a aussi été limitée par la baisse des coûts d'intérêt hypothécaires. L'économie retournant graduellement à son plein potentiel et les attentes d'inflation étant bien ancrées, l'inflation mesurée tant par l'indice de référence que par l'IPC global devrait remonter à 2% vers le milieu de 2015. This outlook balances the many upside and downside risks to inflation. Three of the most important risks emanate from the external environment and include the risks of, first, stronger U.S. private demand, second, a failure to contain the crisis in Europe, and third, weaker growth in China and other emerging market economies. The most important domestic source of risk to the Canadian economy remains the possibility of a disorderly unwinding of household sector imbalances. Against this backdrop, the bank today decided to maintain the target for the overnight rate at 1%. As long as, first, there is significant slack in the Canadian economy. Second, the inflation outlook remains muted. Third, imbalances in the household sector continue to evolve constructively. The considerable monetary policy stimulus currently in place will remain appropriate. Over time, as the normalization of these conditions unfolds, A gradual normalization of policy interest rates can also be expected, consistent with achieving the 2% inflation target. Now, with that, Tiff and I would be pleased to
Craig Quinn, I have Les, and Julian Beltram. Do you guys have a question? Okay, so we'll start with Randall Palmer, Reuters.
Mr. Poloz, we know that you've dropped the reference to persistent strength of the Canadian dollar. Since the last MPR, the dollar has fallen by about 2%. Is that 2% fall, roughly 2% fall, enough to allay your concern about the strong dollar, or are you still concerned?
Well, in general, we would prefer not to offer a running commentary on the dollar in any case. There's no question that Canadian companies continue to face competitiveness headwinds in the export space. But what we expect in our projection is that the strengthening demand in the U.S. will overcome those competitiveness pressures. But in fact, most of those pressures today come from the excess supply that there is in general, globally, in the economy, so that you're competing very hard for each new contract.
You used to, in your previous incarnation at the Bank of Canada, you helped craft the Monetary Conditions Index, if I'm not mistaken. Does the dollar's weakening make it perhaps more likely that you might raise rates at some point in the future in order to keep monetary conditions even?
Well, the dollar will be what it is in the markets, and of course it's a variable that we must take into account when revising our projection, just as we have this time. And normally what we do is we have a convention, whatever the dollar is, at around the time we do the projection, we fix it for the purpose of the exercise. So conditioned on that gives us a sense of where we think things are heading and whether we're getting to the inflation target in due course. And none of that has changed. It's been a very long time since I heard the term Monetary Conditions Index. But it was sort of an old, useful rule of thumb thing that we could use to help us understand the net impact on the economy. But it's a very simple device, much more sophisticated these days, I would say, in the modeling that's done at the bank.
Nirmala Menon, Wall Street Journal.
Governor, when you talk about significant slack, what metric would you be looking at? Because in your report, you talked about discrepancy between various measures. What will you be looking at if you were to rank them according to importance?
Well, there is no individual thing. There's an array of indexes that we can use to give us information on how much slack there is in the economy. What we look at right now and use as our centerpiece is capacity, output, the output gap, if you like. But taken around that, we have a number of measures which relate primarily to the labor market. And just to summarize it loosely, you would say that the output gap appears to be a little smaller than what you would read from the array of labor market indicators that you have. This situation, I think, is symptomatic of what we've been through, which is a significant restructuring of the economy, something which is still ongoing. So we will, as usual, continue to watch all of these and form our judgments around that. All of those things have to be put into context. So there is no single measure, and there's certainly no threshold for any one of those measures.
Those three conditions that you've laid down, we haven't seen them in quite, grouped in a nutshell like that before. I'm just wondering, would you need to satisfy all those conditions? Or will be satisfied with a couple?
Well, that list of conditions is actually a partial list of all the things we would expect to see as the Canadian economy and indeed the world economy returns to a more normal situation. So it's what we've called normalization. In this part of the press release, what we're trying to offer is a deeper clarity, more understanding of what we would expect to see as we get our way back to our inflation target. And so no single one is the most important. They're all sort of a collection of things. They won't all move in a straight line, and they won't all move at exactly the same time. But as I see it, at the heart of this is where are we on our inflation target, because that's where we begin everything. And so the question is, how does observe get back up to target? That's what our forecast is about. And so the first two elements of your list go hand in hand. It is the output gap, which guides the pressures on inflation through time. The mention of the household sector evolution, I think, is very important because it's a primary risk as we look at the economy as it is now. The household sector did a great deal of heavy lifting during the slow global growth period, and the Canadian economy did much better on average than most other economies as a result of that. But the leverage that's in there for households is high, and so it's something we must watch carefully and take it into account in the process of our deliberations.
Greg Quinn, Bloomberg.
Good morning, Governor.
Good morning, Greg.
I'm wondering why language about raising interest rates is in the statement at all. Several prominent economists have said there's not much use to it, even on household debt. The bank and the finance minister have expressed concerns and given clear warnings about household debt. So if the economy is seemingly not ready for a rate hike in the near term, why continue to signal that rates will rise in the future?
Well, it's not how we see this as a signal of a rate hike or something like that. What we're trying to explain is what the natural process of getting home will look like, so that people understand as we go along that this is expected and this is expected. So that's part of the, if you like, a more elaborate description of what the forecast that we have there means from a monetary policy standpoint. So it's not some sort of attempt to signal anything except to explain what things will look like if all goes according to our projection.
Secondly, with these this list of three things, the imbalances and significant slack in inflation remains muted. It could be taken to mean that monetary policy could tighten with a modest amount of slack and just modest inflation and still imbalances in the household sector. Is that your plan to begin raising rates before the economy is fully recovered?
Well, Greg, I'm not going to comment on that specifically. We always set our interest rates according to our best judgment of where inflation will be relative to target. And what we're laying out there is our best judgment as to what will happen between now and roughly 2 years from now. And if that were untrue for one risk or another to the forecast, then we would reassess our policy stance in that light and decide if we were still going to get to our target in due course and revise our stance appropriately at that time. So, and it wouldn't be just those variables. As I said, there's kind of a highlight list of the things that you would expect to see on a normalization path. But of course, in the myriad things we have in our forecast, there are many of those.
Les Weddington, Toronto Star.
Governor, in the report you spoke about the impact of some of the flooding and the train accident in Quebec. I just wondered if you could amplify a bit what you think the cumulative shock of those events might be, or if there's a way to quantify it in terms of GDP impact or that sort of thing.
Well, it's a really tough question, so I'm going to ask Mr. Macklem to take it.
So, Les, we have taken a shot at doing exactly what you asked in the report. In fact, if you turn to box 1 on page 18, we try to lay it out. So there have been a number of events, the Lac-Mégantic, well, first of all, the devastating flooding in Alberta, the construction strike in Quebec, the tragedy in Lake Mégantic, and then the extraordinary heavy rainfall in Toronto and the flooding. The first two of those happened right at the end of the second quarter. And so what you can expect is that they will take something off. They disrupted economic activity. They will take something off the second quarter. And then in the third quarter, as things go back to normal, that'll show up as a temporary boost in growth. And in fact, there will likely be some rebuilding, so that will add a little further. And so, looking at this pattern historically and making some sort of reasonable assumptions, we've made an estimate of what those impacts would be. And as you can see in box 1, we think it's going to subtract about 1.3 percentage points from growth in the second quarter and then put back 1.8 percentage points of growth in the third quarter. So if you look at our quarterly growth, we've got 1% growth in the third quarter. It would be 2.3 if those unusual events hadn't happened. And then similarly, we have 3.8 in the third quarter. It would be 2 if those special events. Now, what you want to take away from this, first of all, is these are estimates. We're certain we don't have this exactly right, but to give people a sense of what we're likely to see. And the other thing to keep in mind is, as the data comes out, it's going to be hard to read. And from a point of view of assessing how much slack there is in the economy, you want to try and look through this. And so we've tried to lay it out to help everybody do that. I mean, just sort of finish. I mean, what it means is, when you look through that, is you've got growth for the rest of this year in the 2 to 2.5 range, underlying growth, even if it's going to look choppier. And then getting into next year, a little stronger, sort of 2.5 to 3 range.
Okay. I guess this kind of follows from that, but Mr. Poloz, you say that growth will be 2.7% in 14 and 15, supported by very accommodative financial conditions. But it seems to me that in terms of business investment, which is increasingly important at a time when governments are cutting back and consumers are strapped, that very supportive financial conditions haven't really produced the effect that one might hope for. So what do you expect from in terms of business financial investment? Why hasn't it been better? And are you hoping it's going to be better? Or is there actually a reason to think it might be better?
Well, Canada is trade dependent and always will be. And so when we're in a difficult global environment like we've been for these last several years, I think it's quite understandable that investment in the capacity that would produce exports in particular has been slow. And we're at that stage now. I think an important point in this normalization story, where the U.S. economy in particular is gathering momentum. So this is an important ingredient that's been missing for the last couple of years. And so as that happens, what we expect to see is the key lack in that calculus that companies do is the confidence that the recovery is real, sustainable, that if they make an investment today, it's going to pay off in terms of their business over the next number of years. Now, we've talked to companies about this in our BOSS survey, and many of them are saying that they have some capacity now to meet an increased demand for those things, but they're anticipating making investments as it becomes more tangible. And so, to me, that's kind of a sequence which is Mother Nature at work. Like, if you were making those decisions, you'd want to be more sure too. And so, because this is real money that's going on the line in order to produce this new capacity. So I think that, as I said in my speech in Burlington, that this is the natural course of events. What we require now is a little bit of patience, as opposed to somehow trying to force something to happen. It's the certainty and the confidence that comes with it that will help. And I would also say that you can't just look at the data and conclude that what we've done in terms of stimulative financial conditions has had no effect, because it's very hard for us to know what the world would have looked like without it, but I could make a pretty educated guess, and I would say it probably has had a significant effect. And so from all that, I'm feeling pretty positive about this outlook. But those conversations suggest that people will remain cautious, but they're primed, they're ready, they have strong balance sheets. So I think sector by sector we will see these outcomes.
Gordon Eastfeld, Financial Post.
Just want to carry on discussing the export sector. In your report, you projected it's going to gather momentum, and there's demand out there for our products. How is this momentum going to be gathered, and where are the products? Who's demanding the products?
Well, the momentum that's gathering is the news in that story, as I've just mentioning, is the stronger U.S. economy, in particular the housing sector and the auto sector. These are two sectors that have been quite quiet for some time. But during the intervening period, during the last 4 years or so, Canadian companies have done a lot of good work to diversify their customer base into other markets that are growing faster. So we did note in the report that the latest survey from EDC says that something like half of companies have found new customers in non-U.S. markets, and that another big percentage are actively pursuing those opportunities and expect to be exporting to those non-U.S. markets in the next couple of years. So that, of course, along with our continued strong trade relationship with the U.S., can only buttress that trade future. Now, that, of course, that's a nice sounding theory. We need to see it accumulating in the numbers. We've seen early signs of it. I refer you to EDC's export forecast, which is far more detailed and very, very thorough, and they, too, are very optimistic on the export growth outlook. So I think that in that context, we have a right to be at least encouraged by that, if not confident. It does still have to unfold, as we hope.
If I can just add one point there. When you look at U.S. GDP, the growth numbers don't look very strong. But a big reason for that is they are undergoing a significant fiscal consolidation. So this year, we estimate that's taking 1.8 percentage points, this year, 1.8 percentage points off growth. So and why that's important is that our exports are not heavily linked to U.S. government expenditures. They're much more linked to private demand in the United States. And so that's growing, 3 to 4% in our projection. You don't see that from the headline GDP numbers.
Yeah. Excellent point.
To follow up on that, the United States, yes, is the obvious market where you pick up and demand. Now, there's also risk in other countries, emerging countries in particular, that could slow exports if that growth doesn't continue. Do you have concerns about that? I know you have concerns, but do you see that situation?
Well, we do highlight emerging markets growth, led by China in particular, as one of our 4 key risks at the end of the report, for exactly the reason you cite. We take some comfort from the fact that these economies are every day getting bigger and bigger, so that slowdowns in growth will matter less in the sense of how much demand they're creating. So one of the statistics I've heard, don't quote me on this because it may not be exactly right, but say something like 7% growth in China today is like 10% just a few years ago, in terms of how much more demand there is for the world from an economy that's getting progressively much bigger. And so from our point of view, that's a growing market, and it's really becoming a very big market, regardless of whether it's growing 7% or 8%. This is almost splitting hairs. But of course, those kinds of things will change, possibly the outlook for commodity prices, which has an impact on Canada. So this is one of the things that we highlight in the analysis. So China is one obvious place to mention, but there's Brazil, India, China. That's the ringleaders, if you like, in the big growth story. And I've spent time with Canadian companies in those markets. I know that those transactions are happening. The bridges are being built. often by the Canadian company making an investment so that they actually have an office, on the ground, so that they're seen as part of the business community. And so I'm confident that that just means we're catching higher tailwinds whenever the growth goes, and have a more diverse trade picture for the next business cycle.
Julian Beltram, the Canadian Press.
Hello, welcome, Governor. I'm going to take one more shot at your forward guidance. The language changed, and some have called it more precise. The Canadian dollar dropped about 0.5 cent on that forward guidance, and I'm just wondering whether you had intended or whether the bank had intended the forward guidance to be seen as more dovish than the previous one.
Well, when we come to write, when I come anyway, to write a press release, I like to start with a blank page, and that's basically what we did this time. We sat down, we wrote down exactly what we think based on our report. We've tried to be as transparent as we possibly can about that analysis. Where are the things that we know well? Where are the things that we know less well? And so that is the sum total of our best judgment at this stage. And how markets react to it, I've a long time ago given up trying to predict how that will actually take place. And what we know is the markets will deliver up what we'll deal with tomorrow.
Not really a corollary. I'll get off the topic. How do you foresee the housing situation? It seems to me that from your analysis that you see continued progress in this. Does the bank see housing as it's been called a soft landing rather than a sharp correction?
Well, in the case of housing, we have to make sure we take it into a full context. Okay, so we are comforted by what we've called a constructive evolution there, which is to say that indebtedness appears to have peaked and has rolled over. Credit data have slowed significantly. So those are kind of important ingredients to this story. And then, of course, you look at the actual housing numbers, the starts, the permits, and so on yourself. On top of that, and taken in that context, the recent data have been a little stronger, perhaps, than you might have expected, given the way it looked just a few months ago. But in my opinion, that's exactly what happens. None of these data ever move in a straight line. And so, as I read the situation right now, the new data we have from the housing sector are just as consistent with the soft landing as they might be with a rebound. It's in that sort of gray zone. So we take that, but from the starting point, it is something that we monitor carefully because there's no doubt that, as I said earlier, the household sector has done a lot of heavy lifting through this cycle. And so those levels of debt are large. And so it's comforting to us to see them drifting down. So that's where we'll leave it for today, unless you have something to add, Tiff.
No, it's good.
Thank you.
I think we're almost out of time, but I have 2 more questions, and Randall really wants a teeny tiny follow-up. So do you have 5 more minutes maybe for us?
We
Quickly?
have. Yes, we do.
So Sean Silkoff from the Globe and Mail is next.
Morning, Governor. Mr. Macklem. Of course, any forecast is out of date the moment it's made, and since this was released this morning, we've got Governor Bernanke's statement, as well as some what some would say are discouraging housing start data from the states. I was wondering if you could address that and how that colors, if at all, what you've just put out this morning. And also, the second part of that question is, how confident should we be in this forecast, given I think you yourself have suggested that the crisis has made forecasting difficult?
Okay, well, those are all good questions. So the U.S. housing number this morning may be a little softer than you might have expected, but as I just said, these monthly data never go in a straight line, and as Tiff likes to say, the good thing about monthly data is there's always another one next month. But the fact is that none of this, you can't expect this to be a simple recovery that goes in a perfectly straight line. So it's important to keep all that variability in context. In terms of the chairman's remarks, I wouldn't comment on those. I barely took a glance at them just before I came. But in recent weeks, they have been emphasizing with clarity what it is they're trying to say to us about so-called tapering, et cetera. And I think that's markets are learning from that, as are we. It's something that we just take into account as part of our exercise. In terms of doing forecasting, I can tell you that has become a more rigorous and a more rigorous is the best word I have for it, I think, than in my forecaster days at the bank. I'm very impressed with the process. It gives me a lot of confidence that all of the questions are being asked, before we reach these conclusions. But I have expressed concerns about the uncharted territory that we are in. That economic models, of course, being based on history, can have a little trouble dealing with a completely unforeseen context. And so in that sense, we're careful to use our models, not just one model, but multiple models, and use those models as tools that help us ask questions as opposed to answer questions. And that helps us inform our judgment and to narrow in the gray zone to make it a little more comfortable for us that we understand it. So I ask you, the parable I gave to the staff the other day was that at one point sailors were sailing the northern hemisphere using the stars for guidance, and one night they got blown into the southern hemisphere and the stars were all different. And so their models didn't work, but they all managed it. They managed to adapt and figure it out, and now the models work just fine. And so it's a little bit like that. We aren't quite at sea, but we are in a territory where the questions are more numerous, and we're working hard on them, doing deep research on them. And I, for one, being a relatively newcomer to the bank, am very impressed with the level of rigor and research that's going on there.
You're using better tools than an astrolabe to guide your
certainly are.
Is it reasonable to expect, when we look at interest rates in your statement today, that they will remain lower for longer than seemed to be indicated by the bank earlier this year?
Well, I would say that the honest answer is we really don't know. Okay, this is a forecast. This is a forecaster's question, if you like. Our best judgment is that all things considered, with the policy that we have in place, inflation will be back to its 2% target around the middle of 2015, and provided that all the elements of that stay on track, we'll remain comfortable with that as a forecast. If something happens to blow us off course, either direction, then we would have to reconsider what our policy stance should be in that new context. But as it looks right now, I think we've got it right.
So does that mean that we could be seeing rate increases in 2015 if you come back to that inflation of 2%?
Well, I won't put a timing on it for you. But what we're trying to explain is that as normalization occurs, there's no doubt that you would get normalization of things like the output gap and the inflation rate, and, exports underneath all that, investment, all those things would be normalizing. And in that context, both market interest rates and, of course, policy interest rates would also be normalizing. And that's exactly why we've been saying to households, please make sure that you do your arithmetic when you're taking on a mortgage so that you're prepared for a higher interest rate whenever you do that renewal. This is the sort of thing you need to be aware of, and I'm confident that people are doing exactly that.
Joseph Rinnick, WBP Online.
I would like to ask about this normalization process, but you've already touched it many times. So can you be more specific? What do you expect from normalization? Just shortly.
Well, I don't know if I can be more specific, but there's no question in my mind. If you look out the window, it doesn't look normal. The world is growing more slowly than normal. Fiscal imbalances in certain countries are significant. Financial volatility is high. We're at the zero lower bound for certain central banks. None of that is normal. So what exactly normal looks like is, of course, very hard to say. But trend global growth, we expect to get back into a more normal range, and with that, inflation would go back into its more normal range. And that and many other ingredients would give you financial markets that look more normal. Those things all kind of go together. The order and sequence is very hard to, in fact, it's not possible to actually lay that out in a simple way. It's that the context, as normalization occurs, our context will be changing each time we get together. And we'll be in a position then to say, yes, this is a sign of a gradual return to normality, and therefore these other things are also signs. So I assure you we've been about as clear as we possibly can about what that normalization is likely to look like.
Do you have a follow-up?
Okay.
So we'll go quickly to Randall Palmer-Reuters.
Just to clarify your response to Greg, Governor, when you said that your language is not a signal of a rate hike. But if all things go according to your forecast, you are signaling that the next rate hike will be next rate move will be up. Is that right? If all things go according to your forecast?
If all things go according to our forecast, then that is on the normalization path that I've described. And I would expect interest rates to be moving on a normalization path sometime in there too. Well, yes. You mean, yes. So, but again, what I want to go back to is that we never saw that as some sort of signal that we were on an imminent tightening phase or anything like that. Rather, it was to help people understand that these are not normal times, so you need to be more prepared for a gradual return to normality. Certainly everything we see suggests it will be very gradual, whatever form it takes. The world is not going to turn normal after the G20 meeting this weekend. Okay, it is. We hope that it continues to heal and that normalcy returns, much like a patient in hospital. That's not a bad metaphor. And if that's the case, then of course you would see all the other ingredients going with it, and that includes interest rates. But that's a very conditional path. There's a lot of things in there that have to happen for that to be true in the window that we're talking about.
Thank you. Before I let you go, Governor, my TV colleagues seem to want to make sure they have your name correctly. So could you please just state your name to help them out?
Okay, my name is Stephen Poloz.
Good. Thank you very much.
Thank you very much. Thank you, everybody.
Thank you.